Hello. So in previous videos, we talked about home depreciation, how to file it on the tax return itself with the tax form. And then we had another video that talked about what happens when you sell a personal residence that had a home office in it and how that affects the exclusion. And now we're going to go through what recapture of depreciation means. So when you sell a home that had a home office in it and we took depreciation on it, we have to do something called recapture of depreciation. And in this video, we're going to go through the details of what it is and how it works with the home office specifically. So this video is going to be really quick on how recapture of depreciation work. The first thing you want to know is what is recapture of depreciation? It's getting a tax benefit when you depreciate. So as we're depreciating the home, we're getting a tax benefit from it. But when you sell at a profit, you have to report the amount you depreciated back as income, either a portion of it, all of it, maybe even none of it. But pretty much what recapture depreciation is adding it back to income when you sell the property. So recapping, once again, recapture depreciation. So when you buy the property, you're gonna depreciate it. And in this case, there's section 179, bonus depreciation. We're not gonna go through that one. We're just gonna assume we depreciated the home office slowly over time. And then when the person or your client wants to sell their personal residence that had a home office in it, we have to recapture the depreciation. And the best way to really understand how recapture depreciation work is understanding the basic of how a normal way of reporting profit or at a gain works, right? So let's just say that we have something where we bought for $10,000 and then we sell it for $12,000, that's a profit of $2,000. So that's the easy way of understanding how profit works. This doesn't include anything with depreciation yet. This is just the basic part. But now let's add what happens when we add depreciation into it. So we bought something for $10,000 and let's just say every year we have to depreciate it $2,000 every single year. So the first year we're going to depreciate it $2,000, meaning that we spent $10 or $10,000 to buy it. We depreciated $2,000. Now we have to adjust the basis. Now this is what the IRS consider as adjusted basis, where we minus the depreciation from the original purchase price. So now the adjusted basis is $8,000. And then the next year when we take another $2,000 off, the total depreciation is $4,000. So meaning that the adjusted basis for this particular property is going to be $6,000. And then on the third year, another $2,000 taken off. So that means $6,000 total depreciation taken so far. And the remaining adjusted basis is going to be $4,000. So the way we do adjusted basis is pretty much you take the original purchase price and you slowly minus out all the depreciation that has been taken over the years, and whatever is left over, that's going to be your new adjusted basis. So it's very possible that if you have a 5-year depreciation life for a certain item and now it's on the 6th year, it's very possible that the basis is going to be zero because what you did was take 1/5 of the cost every single year for 5 years, and now you lower the basis down to zero. So very possible, and most likely that happens a lot, is that your adjusted basis will be at zero. But with this example right here, let's say at the end of the 3rd year, the client wants to sell this item. So remember, they bought it at $10,000. After 3 years worth of depreciation, that's a total of $6,000 worth of depreciation taken. Their adjusted basis is $4,000. And at the end of the 3rd year, they're going to sell it for $7,000. So what do you think that overall gain is going to be? And to get that, all we have to do is find the adjusted basis. Remember, the original price, which was $10,000, minus the total depreciation taken, which was going to be $6,000. Remember, this is the depreciation taken over the year. So 2,000, 2,000, 2,000, that's $6,000. Minus the total depreciation here equals the adjusted basis. So 10,000 minus 6,000 equals $4,000, and the adjusted basis is going to be $4,000. So now that we know what the adjusted basis is, now we can calculate what the overall gain is. Remember, they're going to sell it at $7,000. So what you do is you take the proceeds, which was $7,000 that the item was sold for, minus the adjusted basis, which was $4,000. It will equal out to $3,000. So this is the recapture amount that we're talking about. This is called recapture of depreciation. And for this example that I gave, remember that they originally bought it for $10,000 and they sold it for $7,000, right? So technically that should show kind of like a loss, but because we took depreciation over time, we had to adjust the basis. So now the basis is actually not $10,000, it's $4,000, which now that they sold it at $7,000 creates that $3,000 gain. So that's just a quick recap of what recapture of depreciation is.